Welcome to another tutorial by AmericanBusinessEnglish.com. Please visit our website and subscribe to our YouTube channel to get notifications about our new videos. In this video, we are going to focus on terms that are commonly used when discussing the stock market. Each term is then followed by an example that shows its application. The first term is a hedge fund. It is a pool of funds that is actively managed using a number of different investment strategies. For example, you could say, most hedge fund managers are not able to beat the market despite the fact that they charge large management fees. The next useful term is the institutional investor. It refers to an organization that invests its own assets or those it holds in trust for others. For instance, we could say, institutional investors such as pension funds, insurance companies and universities are assumed to be more knowledgeable and experienced investors. The next term is retail, or individual investors, which means investors who buy and sell securities for their personal account, and not for another company or organization. Here is an example: retail investors who are not knowledgeable enough to pick stocks are better off investing in stock indexes rather than individual stocks. Let's move on to the next term. Return on investment, or ROI, means the performance of an investment, measured by its benefits or returns, divided by its cost. Here is an example. Investments managers usually measure their success by comparing their return on investment compared to the average stock market return. Our next term is price-to-earning ratio, or PE ratio, which refers to the ratio of a stock's price to the company's earnings for the last year. For example, you could say, many investors believe that the stocks are in general overvalued this year because the average price-to-earning ratio is near all-time high. The next commonly used term is percent yield. This term is essentially the dividend payout as a percentage of the current stock price. Here is an example. Investors who are interested in earning a fixed income during their retirement usually prefer stocks with higher percent yields. The SEC, which it stands for the Security and Exchange Commission, is a U.S. government commission created by Congress to regulate the securities market and protect investors. Here is an example showing how we can use this term. The SEC is investigating the company that is charged with publishing misleading annual reports. An index is the next useful term. An index is an imaginary portfolio of securities representing a particular market or a portion of it. For instance, we could say, the Standard & Poor's 500 is the world's best-known index, and it the most commonly used benchmark for the stock market. The next term that we are going to focus on is large caps. These are companies with market capitalizations of more than $10 billion. Here is an example how we can use this term. Since the prices of large-cap stocks usually fluctuates less than others, risk-averse investors are better off buying large caps. A related term is mid-caps. This term refers to companies with market capitalization larger than $2 billion and smaller than $10 billion. For instance, we could say, investing in mid-cap companies offer a great trade-off between the growth potential of small caps and the stability of large caps. The third term that is related to size of market capitalization is small caps. It refers to companies with market capitalization less than $2 billion. For example, we could say, small caps typically offer the highest growth potential for investors, but they are also riskier investments compared to larger corporations. The next phrase is to go public. This phrase means to make it possible for outside investors to buy company shares by offering them on the stock exchange. Here is an example to show the application of this phrase. Many companies, which were planning to go public, had to delay their IPO because of the market crash. The next term is an initial public offering, or an IPO, which refers to the process of taking a company public by selling shares on the stock exchange. For instance, we could say, the board of directors decided to go ahead with the IPO plan because the company needed more cash to continue its growth. The last term that we are going to learn is to underwrite. It means to buy all the public shares at a fixed price and resell them to the general public during the IPO. Here is an example. During the tech bubble, investment banks were in an intense competition to underwrite hot startups as quickly as possible. Hope you found this video useful. For more information, visit our website at AmericanBusinessEnglish.com. Subscribe to our channel to receive updates about our new videos.